fast-paced montage of private jets, skyscrapers, and news headlines about billionaire tax rates. Overlay a graphic comparing a teacher's 22% tax rate to a billionaire's 3% effective rate. Most Americans think taxes are like a subscription service: the more you use, the more you pay. But for the ultra-wealthy, taxes are more like a suggestion. In 2026, while the average W-2 worker is fighting for every deduction, the top 0.1% are using a completely different rulebook. Today, we're breaking down the exact legal mechanisms from buy, borrow, die to tax loss harvesting that allow the rich to keep billions while you're stuck with the bill. Explain the difference between earned income and wealth. W-2 versus assets. Explain that the rich don't take a salary. They take stock options or own appreciating assets. The power of unrealized gains. If your stock goes up by $10 million, you haven't made money in the eyes of the IRS until you sell. The 20% rule. Discuss how long-term capital gains are taxed at a maximum of 20% plus NIAT, while top income earners are hit at 37%. You buy an asset: real estate, tech stocks, fine art. Borrow instead of selling the asset to buy a yacht, which triggers taxes. You take a S-block securities-based line of credit. Why? Loan proceeds are not taxable income. You get the cash, keep the asset, and pay a low interest rate that is often lower than the tax hit. Die. Explain the step-up in basis. When the owner dies, the cost basis resets to the current market value for the heirs, effectively wiping out decades of capital gains taxes. A flowchart showing a small apartment building turning into a massive skyscraper through successive trades. Depreciation. Explain paper losses. A building can produce $100K in cash flow, but through depreciation, it looks like a loss on paper, making that cash tax-free. Exchange the swap till you drop method. Selling one property and buying another to defer all taxes indefinitely. Qualified small business stock. USBS. How founders can potentially exclude up to $10 million in gains from taxes. Family limited partnerships moving wealth to kids at discounted valuations to dodge the $15 million estate tax exemption limit. Tax loss harvesting. Using your losers in the stock market to cancel out your winners.